So what I want to talk about today is non-direct and direct recognition. And we're going to go over what these terms mean and take a deep dive into the numbers so we can compare non-direct and direct recognition policies. But really the question that we want to ask, and the goal is to answer this question, is if you're looking at a whole life insurance policy and trying to figure out if I should go with non-direct or direct recognition, does it really matter? That's the question we'll ask. So let's start off by explaining exactly what these words mean, non-direct and direct recognition. Before we do that though, I just want to go over some misinformation here because this is really what sparked the idea for this training video. It has to do with the subject of direct recognition. If you've done any amount of research, have you ever heard this about direct recognition? That direct recognition means you do not receive a dividend when you take a loan. Is that your current understanding? Have you ever heard anything similar to that? Here's the thing. It's not true. With direct recognition, you still receive dividends when you take policy loans. So with that said, if what I said is just true, why is there misinformation about direct recognition? Well, there's a million reasons why. Here's 3 reasons I see a lot. Number 1, the agent explaining it might not fully understand direct recognition. And this can happen because there is a learning curve there. Number 2, the agent explaining it might primarily sell non-direct recognition policies. And then number 3, non-direct recognition is a lot easier to understand. You'll see that when we look at the examples. But does it really matter if I go with a non-direct or direct recognition policy? We'll answer that question with numbers in a little bit, but I'll say this, full disclosure, IBC Global sells both non-direct and direct recognition policies. So let's explain the two quickly. Let's start off with the easy one, which is non-direct recognition. So what this means is if you take a loan against your life insurance policy, the insurance company is still going to pay you a dividend on that entire cash value. Now, non-direct recognition, like why those words? What does it mean? Here's how it works. If you take a policy loan, you're going to get the same dividend rate on any money that is in cash value, meaning money you have not borrowed, and then also any money you have borrowed. Think of it this way. If you have a non-direct recognition policy, that means that the insurance company does not recognize when you take a policy loan, and they pay you the same dividend rate as if you never touched the money in the first place. Very easy, and you're going to see an example of that in a little bit. Now, one thing to note here about non-direct recognition is that we'll usually have a variable loan interest rate. So with direct recognition, when you take a policy loan, the insurance company will still pay you a dividend on your entire cash value. Here's the difference. If you take a loan, you're going to get a different dividend on money that is borrowed when you compare that with a dividend that you'll get on money that is not borrowed. And that dividend that you get on borrowed money could be higher or it could also be lower. And we'll look at an example of a dividend that's lower, but it does depend on the insurance company and their practice. We've got several videos that demonstrate both on our YouTube channel. If you'd like to check that out, we've included a video in the description of the comments below too. Think of it this way. The insurance company directly recognizes that you take a loan and they adjust the dividend rate applied to those loaned dollars. And really why they do this is because they want to make sure that all of their policyholders are treated fairly. If you have a life insurance policy with a mutual company, who owns that company? Technically, the policyholders. That's how mutual life insurance companies work. So direct recognition is a practice that some companies have to make sure everyone is always treated fairly. And again, that does not mean that every time you take a loan, your dividend is going to be reduced, although that's the example we'll look at today, which will be cool. Now, for money that you don't borrow, you get whatever the company's current dividend rate is. Now, regarding the loan interest rate, most direct recognition policies will have a fixed loan interest rate. So with a fixed loan rate, the rate will not adjust. I know what my interest cost is going to be every year, and in most cases, especially right now, the beginning of 2024, the fixed loan interest rate is lower than where we see variable rates. So before we get into the numbers, a little bit of info that I think will be really valuable. When I look at dividend rates, anytime you see a dividend rate on a life insurance policy, know that that is always a gross rate, meaning a 6% dividend does not mean that your cash value is going to grow by 6%. A 6% dividend might equal a 5% net return. That's after I've had a policy for several years. Loan interest rates. Loan interest rates are net rates. A 5% loan rate means that you are going to pay 5%. Let's take a look at the scary version of direct recognition. Now, what I mean when I say scary version is when the dividend rate is reduced when you take a policy loan. If I said to you, yeah, with this direct recognition policy, the company is going to lower your dividend when you take a loan. How do you feel? You feel like you're being punished? Do you say, I want non-direct recognition? Do you feel like this? You're Boo on the left. You've got Sully yelling at you. Sully is your direct recognition policy. However, what happened in that movie? They turned out to be great friends. Don't worry. It's not that scary once you see the numbers. Let's take a look at an example of non-direct and direct recognition. So we'll consider the same insurance company that offers both non-direct and direct recognition. We'll look at the same product and we'll start out with no loans just to keep things simple. So we'll look at a Guardian example here. Guardian's current dividend rate is 5.9%. Remember, are you earning 5.9% on your money? No, the dividend rate is always a gross rate. Let's pretend that the net rate is 5%. So if you have $100,000 in cash value today, you pay nothing in, you earn 5%. Tomorrow or 12 months from now, you'll have $105,000. Now let's look at a non-direct recognition example. Again, we'll assume you have $100,000 in cash value. Your dividend rate is 5.9%. You take a policy loan of $50,000. You have a variable loan rate of 6.2%. That is Guardian's current loan interest rate as of February 2024. 6.2% of $50,000 is what? $3,100. That's your cost to borrow. Now, what happened to the $50,000 you did not borrow? You get the same 5.9% dividend on that because it's not borrowed. What about the $50,000 you did borrow? You get the non-direct recognition dividend of 5.9%. Non-direct recognition means you get the same dividend no matter what, if you take loans or not. Now, let's assume you repay the $50,000 loan and you do that in 12 months, in 1 year. Your cash value is $105,000. That's the same number we saw in the example where we never took loans. So what you got is a 5.9% dividend on the money you didn't borrow, then a 5.9% dividend on the money you did borrow. So how much did you get in total? That $5,000. It was $100,000 last year, then this year was $105,000. What'd you pay? 6.2% on the loan amount. That was $50,000. How much? $3,100. So again, you got $5,000. You paid $3,100. You're positive $1,900 in this specific example. Got it? Good. Fun stuff. Let's look at direct recognition. Same policy. You've got $100,000 in cash value. Dividends 5.9%. You take a $50,000 policy loan, although this time you've got a fixed loan interest rate of 5%. What's your cost? $2,500. 5% of $50,000, $2,500. What happens to the money you did not borrow? That $50,000, you get the dividend rate of 5.9% because you did not borrow it. Here's the question though. What happens to the $50,000 I did borrow? You get the direct recognition dividend of 4.5% in this example. This is the scary example. So the direct recognition dividend is a different dividend rate than the company's current dividend rate. So how does this impact you? You repay that $50,000 loan in 12 months, your cash value is restored, but a little bit less than what it was before. It's worth $104,400. That's $600 less than what it would have been if you never borrowed it in the first place. How do you feel? You feel like this? They reduced my dividend to 4.5% on borrowed money? If I take $1 million loan, that's going to be a big, big difference, isn't it? You're afraid. There's your direct recognition policy. Again, don't worry. It's not scary once you see the numbers. So, with direct recognition, what did you get? On the non-borrowed $50,000, you got the 5.9% dividend. On the borrowed $50,000, you got the 4.5% dividend. The net came out to $4,400. What did you pay? Your cost to borrow was 5% on $50,000. You paid $2,500. What's the net impact there? You're still positive $1,900. Let's compare them side by side. First, we'll look at the earnings. So non-direct recognition. The cash value after you paid the loan back was $105. The same dollar amount it would have been if you never touched it in the first place. Whereas with direct recognition, the cash value was $104.4. Non-direct recognition looks like it has an extra $600 in earnings. That's the better option. However, we want to look at our cost. With non-direct recognition, you paid a total of $3,100. Whereas with direct recognition, you paid a total of $2,500 in interest. Direct recognition had $600 in interest savings. What's the difference? There is no difference. You earned $600 more with non-direct recognition, and you saved $600 in loan interest with direct recognition. Here's how I like to look at it. Pepsi or Coca-Cola. We'll pretend Pepsi is non-direct recognition because we've got both those colors in blue. Pepsi and Coca-Cola say they're different. Here's the thing. We all know they're the same. I might tell you Pepsi is better if I want you to buy Pepsi. But at the end of the day, it's the same thing. Or they are so similar that most people can't tell the difference. Like, I got my soda here. What's the difference? Who cares? I hope that you don't prefer Pepsi or Coke. When I was a kid, I preferred Pepsi a lot because Jeff Gordon had those commercials where he was drinking Pepsi, and I liked his car. I thought it was cool. Anyway, with that said, it's not always exactly the same. Sometimes it can be different, but if the numbers are different, it's not very much. Here's what we usually see with direct recognition. If it's a case like the one we just talked about, where the dividend rate is reduced on your cash value when you borrow it, you'll usually end up paying less in loan interest. So the net difference is usually minimal. Sometimes it's next to nothing, and sometimes direct recognition even looks better when we look at the net numbers. A lot of times that's the case. So let's take a look at two examples. We'll look at a case study with someone taking out a $100,000 loan, paying it back in 1 year, and then a $350,000 loan and paying it back over several years. What we'll look at is a guardian policy with both non-direct and direct recognition, as they do offer both options. This allows us to look at one product and look at a clean apples-to-apples comparison. The loan rate right now with Guardian's non-direct recognition policy is 6.2%, and then with their direct recognition policy is 5%, and that fixed rate will never change. The variable rate likely will, which will impact this case study. Let's start with the 100K loan and non-direct recognition. So we've got our non-direct recognition policy. On the left, we see what it looks like with no loans. On the right, we see what it looks like with that 100K loan and then paying it back. So again, our variable rate, 6.2%. Here, we take out a 100K loan. There's your loan interest, $6,200. You make a loan payment the next year of $106,200. You pay it back in full. Your cash value after it's repaid is $711,000. What's it on the example to the left? It's exactly the same, $711,000. How much did you pay in loan interest? $6,200 when I look at that. Okay, so let's look at direct recognition and then we'll compare the two side by side. The same $100,000 loan. Direct recognition. You've got a fixed loan interest rate of 5%, a lesser cost to borrow. There's your $100K loan. There's your $5,000 in loan interest. The next year, you pay it back in full. There's your cash value, $709. What's it on the example to the left? $711,000. It's more when I never touched it. How much did I pay in loan interest? $5,000. So, let's compare them side by side to see which one wins. Again, we've got a side-by-side comparison here. So both of these examples display the $100K loan. What is the cash value in both of them? Non-direct recognition has more, $711 compared to $709, almost $710. How much did I pay in loan interest? Well, direct recognition is more favorable. I only paid $5,000 out of pocket compared to $6,200 with non-direct recognition. What's the difference? Cash value difference. You've got almost $1,500 more in cash value with non-direct recognition when the loan is paid back. What about interest paid? Well, you've saved $1,200 in loan interest if you've gone with direct recognition. What's the net difference? $270. Next to nothing. And if that loan rate goes up, that variable rate goes up, guess what's going to happen? These numbers are going to be even closer, or it might even end up being in favor of direct recognition. Let's look at a bigger loan, $350K. So non-direct recognition. This is the exact same policy, by the way. What happens here? When I borrow and repay, there's my cash value, fully restored. So we have that $350K loan. There it is. I skipped over that point. $350K loan, pay it back, $50K per year. When it's repaid, $1,049,000 compared to the example to the left, the same $1,049,000. Interest paid, $123,000. Let's look at this exact same policy, but with direct recognition. Year 21, what's your cash value? $1,049,000. Okay. Direct recognition. Here we go. What's your cash value? Year 21. $1,049,000. How about to the right in the example where you take that policy loan? Now what you got? Different value. $1,012,000. What happened here? You took that $350K loan, you paid it back exactly the same as the non-direct recognition policy, but you had less. The reason why is because you received that reduced dividend rate on the borrowed cash value. That is why you have less in cash value once it's paid back. However, what do you notice here? You paid a lot less in loan interest. The last example was more than $120,000. Let's compare them side by side. So, what do we see here at the cash values? Non-direct recognition has more. What about the loan interest? Well, non-direct recognition also has a higher cost to borrow. What's the net difference? Cash value difference. Direct recognition has almost $37,000 less in cash value. The interest paid, however, with direct recognition, I saved almost $32,000. So the net difference, when it's all said and done, comes out to about $5,000. In a case where over 20 years I paid in $100,000 in the first year, then $50,000 per year through year 10, took out a $350K loan, paid it at $50K per year, net difference over that 20-year period is $5,000. It's about $250 a year when we look at it. And again, if that variable rate goes up, these numbers are going to be closer. So not much difference at all when we look at it. So does it really matter? Well, no, it doesn't. In my opinion, like when I look at it, I have not seen much of a net difference. And here's the big thing. When we look at whole life insurance policies over time, not just illustrations, which is what we just looked at, but over time, what we've always found is that policies from the top 4 mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, have consistently produced the highest actual cash values to their policyholders regardless of their stance, if they're non-direct or direct recognition. We've never seen that be a deciding factor in someone having a boatload more money in cash value or anything like that. Really, what I always like to talk through first and what helps people refine their decision-making process is flexibility. Really the ability to adjust PUA payments at leisure. That's the big thing, and not have to go through underwriting. And then also, the ease of taking policy loans is typically more valuable to most than the topic of non-direct and direct recognition, after they understand how it actually works. So, to wrap things up, what if I'm still hearing mixed opinions from agents about non-direct and direct recognition? I'm afraid, I don't know what to do, and I don't want to make a decision that's going to end up in me losing money or anything like that. I don't want to have buyer's remorse. Here's what I would say. First, take your time, review the numbers. What's the rush at the end of the day? Number 2, ask to see illustrations with and also without loans. Number 3, if you're comparing non-direct and direct recognition, always be sure to account for the loan interest in the comparison. That's so important. And if the non-direct recognition policy has a variable loan rate, ask, what would it look like if that loan rate increases by 1 or 2%? Then what's the difference? Number 4, ask questions until you really understand what you're getting. Where people often have buyer's remorse is when they get a policy and then they find out that it worked a little bit different than what they thought, just because they didn't fully understand it from the get-go. So asking questions and really not starting until you understand it goes such a long way. And that's the truth with anything. And then number 5, remember that it's your money, not the agent's. That's so, so important. You can ask questions and take your time. That's okay. If you would give that advice to your friend or your family member, that's usually the best advice you could take. Usually we are fantastic at giving advice, but we're horrible at applying it. So with that said, I do hope that this helps regarding the subject of non-direct and direct recognition. We'll talk to you soon. Bye for now. Thanks so much for watching.